Welcome to the Daily Update, where I'll go over the action in the market for Monday, July 24th, and then we'll see how things look for Tuesday, July 25th. We had a slight up day. It's a little bit frustrating on one hand because we're still dealing with this overbought situation. We still have some of those negative setups that could suggest a short-term pullback, but at the same time, the market's holding up. That's positive, and things are still looking okay. But we have some major things coming out later in the week that could have a real influence on the market. There's going to be the Fed and making their announcement. We have some major earnings reports coming out. The scenario that seems more rosy right now, that's still in the background. But remember, that could change at any time, and things could quickly switch over to negative or just reinforce the positive. So let's go back and talk about what happened. Right at the open, we did have a higher open. Prices went above R1 at 45.49. Then they fell back and found support at the daily pivot at 45.42. As the day went on, prices rose back above R1 again and eventually went slightly above R2 at 45.62. Then we fell back down to R1 and then we closed slightly above R1. So we were up 0.4% on below average volume, and that probably shouldn't be a surprise. Major things happening later in the week. It's the middle of summer. So to see volume drop off is not really all that unusual. The technicals were still positive. We're still hanging into this positive backdrop because everything is about inflation and interest rates and then earnings as they are released. What are some comments that we can make? The NASDAQ 100, it didn't fall apart when it opened on Monday. There was the rebalancing that happened, and there was a lot of speculation going, wait a minute, all these companies are going to get readjusted. That's going to make the NASDAQ 100 and the NASDAQ and the whole market just go crazy. Really didn't happen all that much. As then folks lightened up on the more weighted stocks, well, they had to buy the other stocks in the NASDAQ 100, so it seemed to kind of even things out. We're still wondering if there's this convergence of negative signals suggesting a short-term pullback. Some of them are getting a little weaker now. Some of them are still present. The positive scenario that the market's been developing, that we'll have a soft landing, meaning economic slowdown without going into a recession, that the Fed is almost done raising interest rates, and that earnings growth looking into the future still looks positive, that's what the market continues to hang on to. But again, remember, it can change almost instantly to something else. On a short-term basis, our list is still kind of long. We have the moving average study, the Williams percent R, the CCI 14 again, and 20, standard deviation, and the stochastics. Those are all extreme positive, suggesting that on a short-term basis we're overbought. We still have our intermediate term overbought indications, the rate of change going back 50 periods, the PMO studies, the oscillators, mostly for the NASDAQ 100. That is still turning more negative. The Sean trend meter and the bullish percent index for the S&P as well as the NASDAQ 100. On a long-term basis, the moving averages are still looking extreme positive. The dollar was up and interest rates were also up, which gave a little bit of headwinds to stocks, but didn't seem to have that much of an impact. The yield curves that we watch are still inverted. Sentiment is still extreme at 83. It ticked up. Where it had been at 80, then it went to 81. Now it's at 83. Our trend is positive. The green line continues to come down. You could say on one hand that maybe we're working off this extreme positive situation, but we still default to the positive because the green line's on top. Both the ADX and the moving average are above 20. Our bias is positive and our momentum is positive. The economic reports that came out, we had the S&P Global Manufacturing PMI. It came in at 49, more than the 46.3 they had expected. And then we also had the Services PMI. It came in weaker than expected at 52.4. Last time it was at 54.4. Here's the chart showing the manufacturing PMI, how it did tick up, but it's still underneath 50. And here's the services, which is declining, but it's still above 50. IsabelNet.com blog charts. We have the S&P 500 level right now, which is around the 4,500 level. And earnings per share, Goldman Sachs is still predicting a rosier future with earnings going up, and that's justifying higher stock prices. Also, we look at the forward PE multiple. The dark blue line is the multiple itself, and it's starting to get high. And now we compare that to the real 10-year Treasury yield. Real means you take inflation into account, and we're starting to get a pretty wide spread between the two. Are these going to be able to come back into equilibrium with each other? They tend to not get very far apart. Now they are far apart. Are interest rates going to start to go down because this is an inverted scale, or is the PE multiple going to end up coming down? Then we're looking at the rolling 4-week average of flows. They've been positive since the middle of January. Those are the dark blue lines here above and below the zero mark. And then we have the S&P 500 on there as well, showing that there's a lot of money going into the market. The bubble may be over in T-bills. We showed this chart recently. When interest rates were really going up, folks were getting into T-bills. Those are shorter maturities, and you want to get into those because once they mature, you can roll over into a higher interest rate. Well, now that folks are feeling more confident about interest rates, they're starting to get out of the shorter-term bonds and getting into the longer-term bonds. Oil, we don't focus on that all that much other than keeping an eye on the price. It says JP Morgan expects Brent oil prices to exit the year at $86 a barrel. The fair value is the blue line, and the actual or forecast is the black line, and they're pretty much on top of each other. But they're still predicting that oil prices are going to go up from here. Now, I usually include this over the weekend, the current market valuation charts, but they just weren't updated, so I wanted to go ahead and include them here. Overall, we are overvalued. And looking at the historical chart where we're above the 1 standard deviation, so the market is considered to be expensive. Now we break down some of the other models inside. We look at the PE model. It's overvalued above the 1 standard deviation. The interest rate model is fairly valued. We're above the historic trend, but not up to the 1 standard deviation. The mean reversion, how far away from its mean or average price, we're above the 1 standard deviation, suggesting that we're overvalued. And then our recession indicators, because we have so many yield curves that remain inverted, it's very high. In our state coincidence model, it's normal. We're not seeing a lot of problems in the individual states. When this climbs above 25, that means that a lot of states are having economic difficulties, and we're probably, as a nation, in a recession at that point, and we're just not seeing that right now. The sentiment model. We did finally get an update on margin debt, and it's starting to go up. As the market's been going up, people are willing to borrow money to buy stocks. We're coming back up to the historic trend line, so we are neutral. But if this line continues to go up, that might mean that folks are taking on a lot of additional risk, which when we get extreme could suggest that we're overly optimistic about things. Then the junk bond spread model is neutral. We're above the historic trend line and not up to the 1 standard deviation. Getting back to our charts and analysis, here's the intraday chart. We had a higher open. We went above R1. Didn't quite make it up to R2 right out of the gate. We came back down to the daily pivot, found some support there, and then chopped our way higher, eventually making it up a little bit above R2. We saw some selling later in the day and then a little bit of buying going into the close, so we were able to close above R1. Here's the intraday chart, where in Sunday afternoon we saw a little bit of a tick up with the futures. That carried over into the cash market, and we're pretty much trailing off in the initial overnight session. We did see a pretty good day for growth. It's showing some improvement, but overall, value continues to outperform growth. But on a closing basis, large cap growth did outperform large cap value, or for the mid caps it underperformed, and for the small caps it was up, but also underperformed value. Here's the growth to value ratio. We were above the dashed line, meaning that we were positive. So that's an improvement, but we want to see more strength out of this ratio if we're going to get the buy low, sell high type of an environment that we want. Sentiment. The Ulcer Index is still suggesting there's not a lot of fear. Seeing a confirmation of that, we ticked up a little bit with the line chart with the VIX as well as the bar chart, but not much of an increase in fear. Kind of strange. We had an up day and the VIX also went up. The VIX of the VIX is actually showing a decrease in volatility of the VIX. We're keeping an eye on the VIX to S&P 500 correlation. This continues to drop after it's spiked up and is coming down. The context for this seems to be that that's more negative for the market, but we're not seeing a real influence of that, at least yet. Looking at the equity put call ratio, 5 periods, a little longer look at this chart. Now we're trying to figure out, did we bottom with this ratio and now we're starting to go back up, or is it going to turn and go back down? This is a longer term version of that same chart, also showing that we're coming back up a little bit as the market has been going higher. Typically this will go down as the market goes up, so we're keeping an eye on this. The longer term equity put call ratio continues to decline, and that's positive. And then we look at a different chart of what I just showed you about margin debt, where it is increasing a little bit. This data doesn't update very often, and it comes from FINRA, so it's not like we can really use this to make decisions. This is just something that we need to know about. Sentiment is suggesting that we're still pretty extreme positive, which we're seeing that line up with our other indicators. Here's another indicator showing that we're seeing extreme optimism right now, or extreme greed. We're also seeing our one fear gauge continue to decline, suggesting there's not a lot of fear, and this other fear gauge also continues to decline. We did see a drop in the ratio between risk on and risk off, but overall, folks are favoring a risk on position. Then inflation worries are up and credit crunch worries are down. Folks are worried that the Fed's going to be hawkish for too long, where folks had been more worried about a global recession. That seems to be trailing off just a little bit. And then here's the AAII bull spread. I showed this in the video over the weekend. We get this once a week, suggesting that individual investors are getting pretty optimistic, but not necessarily extreme optimistic. When we start getting at 20 or above, that's when we're looking at this as a contrarian indicator. Our advanced decline line studies, we're still seeing improvement based on price as well as volume. So that's holding up fairly well. Looking okay with the new highs. They're trailing off a little bit, but our 5-period moving average is going up and our 10-period is also going up. The advanced decline ratio, above 0 and advancing, that's positive. This is a little bit of a concern. We're 2 days now in a row with accumulation distribution dropping below the moving average. This attempts to measure what's the smart money doing. Are they selling into strength? Looking at the cumulative NYSE advanced decline line, we did see some improvement. We're also seeing some improvement with the regular advanced decline line and breaking out above previous highs. Our other advanced decline line is also showing improvement and breaking out above previous highs. With our common stock advanced decline line showing some improvement, coming back up to a previous high, getting close, seeing a little bit of a lag based on volume, so that's a slight negative divergence. With our advanced decline line studies, we're seeing improvement with the NYSE, the S&P, a little bit of a turn up with the mid caps and the small caps. Our trend, the green line is still declining even though it's on top, so we default to positive, but it's now coming down from this 40 level. The ADX is still above its moving average, so we're in a positive trend, but it is showing a little bit of weakness and a little bit of working off that extreme reading. Our shorter term ADX chart also coming down, rolling over a bit, but still positive. Volume did drop off in Monday's session. We had been above average for many days last week, so this is continuing to show a little bit of a decline. Short-term chart, we seem to have come up to the underside of this trend line and came back down, and now we're wondering, can we break back above that, or are we going to fall down from here? On the bottom, we see where volume did drop to below average. We're still hanging in there with our double and triple 20-period exponential moving averages. We're right on top of both of those. We're a little extreme with the 20-period exponential moving average, but it ticked down barely. You can hardly see that. Rolling over a little bit with the 50, but still showing strength with the 200 and not looking extreme yet. The Williams percent R, after coming back down, has now gone back up to be extreme positive. The CCI 14, no longer extreme positive and is now dropping down. But the 20 period is still looking a little bit extreme positive, even though it's falling. Short term, stochastics in the short term, extreme, coming down but still extreme in the intermediate term, also coming down but extreme in the long term. The force index ticked up just a little bit, that's positive. Our intermediate charts, the balance of power, we're no longer extreme positive and we're above the dashed line. It ticked up barely, so that's positive. With our 50-period double and triple exponential moving averages, we're still hanging on to the triple exponential moving average here. That seems to be providing support. If we start to fall, we'll be seeing if this blue double exponential moving average may provide some support. The go-no-go system still remains positive with the darker blue bars. We're coming down off the highest high reading, but we're not down to the midpoint yet, so we're not seeing a lot of movement in this chart. The TTM squeeze continues to be positive with the lighter colored blue bars. We're getting back up into the third standard deviation now, suggesting that maybe we continue to go up a little too far too fast, which may imply that we're in an overbought situation. The rate of change going back 50 periods after a drop back down now went back up slightly. It's just barely extreme positive. The PPO studies across the board on the weekly chart still continue to be positive. The Erin pretty much went sideways. We're seeing a little bit of a decrease in buyers, but also a decrease in sellers. The S&P 500 McClellan oscillator ticked down just a little bit, but we're still above zero. So our summation index based on price is still going higher. We're lagging a little bit based on volume, so that's a bit of a negative divergence, but it continues to go up. The NYSE McClellan oscillator ticked up just a little bit and is above zero. So our summation index based on price is advancing as well as volume. We're coming back up to some previous high based on volume. We still have a ways to go based on price. This is also positive. For 2 days now, we've seen the Swenlin trading oscillator based on price and volume start to turn back up. The Elder Impulse system for the S&P still remains neutral. And the PMO, rolling over just a little bit, but is still positive. We continue to advance based on price and volume. The study inside of the PMO, we're seeing a bit of a decrease with the PMOs that are rising. Also a little bit of a turn down with the buy signals, starting to get extreme positive with the PMOs that are above zero. Again, you can see this as negative, that we're getting extreme. You can also see this as positive, that means more stocks are participating. The parabolic SAR remains positive with the dots underneath. The slope indicator's rolling over a little bit, but is still positive. The MACD also rolling over, but positive. All of our oscillators, we're pretty much beyond these negative divergences now, since we're going back and making new highs. The market is still really not all that convicted when it comes to our longer term oscillators, the TRIX and the KST. The Sean trend meter continues to be extreme positive. And the BPI, this also can be taken two ways. We're getting extreme, that's negative. But it's showing more participation, that's positive. But we're getting to a pretty high level with the BPI. Also, the NYSE BPI continues to show improvement and is not extreme. The Chaikin money flow ticked up just a little bit. That can be encouraging. This tries to measure what's the smart money doing. We saw a little bit of an improvement on Monday. But the Chaikin oscillator is now below zero and declining. That's negative. The money flow ticked up just a little bit and is still above 50. That's positive. But we're declining with the ultimate oscillator. That's negative, but we're still above 50. That's positive. The vortex, green line's on top, but it is declining. On balance volume continues to show strength. Looking at our RSI study based on 14 periods, starting to get back extreme. We're already extreme with the 9 period. Again, as we're going back higher, it may negate this negative divergence that we've been watching. We're seeing some improvement with the 200-day moving average study in the S&P. It's ticking up slightly, and we're seeing a little bit of improvement with the 50 period, but it's lagging behind slightly. Here's another look at that same chart using a histogram. The Koppik curve is rolling over a bit, but is still generating a buy signal. And the Pring bottom fisher, we haven't generated a signal yet, but we could be getting ready to cross this red line. Now, that's positive. That would generate a buy signal, because this indicator can be good sometimes at finding bottoms in the market. The only problem is we're just below the zero line. You can say, well, we didn't get really extreme negative, but at the same time, when we get really good signals from this indicator, it's when they get really down low and then start to turn up. That signals a bottom. So it's kind of strange that we're seeing a bottom here without the market really falling all that much. I don't have any Fibonacci and line studies because we're still in no man's land. Our different charts, the Heikin Ashies turning back and looking more positive. The Kegi is positive but still pointing down, so it's positive with a negative slant. The Renko chart continues to be positive, and the 3-line break is also positive. our different indexes, we are seeing some improvement with the equal weight. If there's one thing that we're kind of seeing here is that some of the big stocks are not having as much influence now, and folks are starting to get into some of the smaller stocks, and that's helping the broader market to improve. We're also seeing a little bit of that with this ratio, where it's coming down. Even though it's the big stocks that shot this ratio up, even though we're falling off, we can still see this as potentially positive. Looking at Dow theory, still going up with the Dow, turned down a little bit with the transports, ticked down just a little bit with utilities after having a good day on Friday. The transports to S&P 500 ratio did tick down on Monday, but it's continuing to go up. We want to see this ratio really continue to go up if we want to see the S&P get some good solid support. And the relationship between the S&P and the transports is weakening slightly. The Dow and the transports are performing about the same, so we're seeing the transports starting to pick up. We'll see if they can actually overtake the Dow. Looking at our discretionary and staples equal weight study, we were pretty much sideways with discretionary. We went up slightly with the staples, ticked up just a little bit with the ratio, and we continue to be in an overall uptrend, suggesting that discretionary is outperforming staples. The Dow is going above this R1 level and was up a little bit over 0.5%. The diamonds continue to be positive with green bars. The NASDAQ, after coming up to this R2 level, dropping back down, we continue to be below R1. Also with the NASDAQ, we're watching the 61.8 retracement level. If we continue to fall, we'll be watching the 13,874 level. The cumulative new highs minus the new lows for the NASDAQ is still trying to turn up. We went just slightly negative when we take the raw score, the new highs minus the new lows, but overall, we've been seeing some weakness in this area. Also keeping an eye on the NASDAQ 100, came up to this R2 level, broke down, also came below R1. We're wondering, are we going to continue to fall or will we be able to turn back up? If we keep falling down, will this previous high now act as support? The Qs have switched from negative to neutral, and this is another potential concern. The BPI for the NASDAQ 100 is starting to roll over. It hasn't quite crossed this line yet to give us an official overbought signal. But if this continues to fall, that could put some real weight on the NASDAQ 100, which in turn could have influence on the S&P 500. The small cap index is still above this R1 level and was up over 0.5%, and we are still seeing a golden cross with the S&P small cap index. When we look at the Elder Impulse system, though, the small caps remain neutral. The small caps tick down just a little bit against the S&P 500 and continue to underperform. Looking at the Russell 2000 index, we're still not ready yet to try to test this overhead resistance, but the RSI is turning back up after being extreme positive, and the MACD is rolling over but continues to be positive. The small cap growth versus small cap value, we are seeing this trail off, but it continues to be in an uptrend. The mid caps also, this is kind of the stronger area of the market right now. Now that could always change though. We're still holding up above this R1 level after generating a recent golden cross. But the Elder Impulse system for the mid-caps remains neutral. When we look at mid-cap growth versus value, we did see it really trail off, but overall it still is in an overall uptrend. The dollar trying to bounce back after dropping below 100. It was up again in Monday's session, and we broke down above the all-time high with the FANG index, even though we ticked up a little bit on Monday. Can we go back and give this another try, or are we going to see follow-through weakness? When we look at the S&P 1500 and compare it to shorter-term bonds, stocks are still outperforming bonds. And then another broad market measure with further out bonds, still suggesting stocks are outperforming bonds. The tech sector ticked down just a little bit, but continues to outperform bonds. The S&P to bond ratio is still suggesting that the market thinks anyway that we're likely to see a soft landing. Growth did not have a good day on Monday, and it actually underperformed value, but is still outperforming overall. The NASDAQ 100, this is what we're watching. We saw a negative divergence where the NASDAQ 100 was making higher highs. The PPO did not confirm that, and now we're turning more negative with the PPO momentum oscillator. Keeping an eye on banks, they were up again, up over 2%. We're seeing some real strength in that area. The financial sector is also showing some improvement, but not enough yet to generate a golden cross. The financials are showing some improvement against the S&P, but are still in a downtrend. And the regional banking ETF also ticked up, but continues to be in a downtrend compared to the financial sector. Bonds. We saw an increase in the 10-year yield and a decrease in the 10-year price, and we've dropped below the 200-day moving average. When we compare the Qs and the TLT, the longer-term bond ETF, we're seeing some improvement in the longer-term relationship, but they're still having a tendency to go in opposite directions. Folks are still favoring more riskier bonds over more conservative bonds. We saw this ratio coming down last week. Well, now it's starting to go back up. When we compare cash to the 3 to 7 year bond, we're starting to go back up with this, meaning there's uncertainty about interest rates. In a more healthy environment where the market is more sure about interest rates, we would want to see this ratio going down. We're still above that 3-month yield going back to 2007. We're just watching this day in and day out to see what happens from here. Our long-term charts, the special K is still positive on the daily chart. Here's the weekly chart where we're showing some improvement, but we continue to be negative. You could say it's a little more positive since even though we're below the red line continues to advance. Our longer-term moving average study, looking extreme with the 150 and 200 period simple moving averages. We're also keeping an eye on the weekly chart and this longer-term resistance. For the S&P, we still remain above this line, but it's going to take some time for this to play out. We're also seeing that same thing with the NASDAQ 100. We're still above this resistance level, but we're going to have to see how this behaves going forward. And then looking at the NASDAQ 100 to Dow ratio, we ticked down just a little bit. We're still at an extremely high level. When we were at these levels before, that often meant bad things for the market going forward. We're not sure if it's going to play out that way this time or not. We're just keeping an eye on this. An update of our possible positive scenarios. We did see the Qs drop down below the moving average compared to the S&P, as well as discretionary to the S&P and large cap growth underperformed large cap value. Looking at our growth to value ratios, we saw weakness with the large caps, mid caps, and small caps. The S&P to utilities ratio ticked down slightly but continues to go up overall, which often gives good support to the S&P. We're still looking good in this chart. We've spent a number of days now above 90 when we look at the 10-day average of the S&P 500 highs minus the lows. That's suggesting good momentum. If we fall from this level, then that's when we'll start to turn a little bit more negative. When we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we continue to be positive. That's suggesting that there's more strength in the broader market. The 50-period exponential moving average of the new highs minus the new lows continues to advance. The black line is our indicator. It came down a little bit, but the red line, which is the moving average, that continues to go up. Growth versus value, pretty much sideways. We're still in an overall uptrend, but we have been trailing off lately. Not as strong as what we would like to see. The Staples S&P 500 ratio did come back up, but continues to go down overall. So what's our outlook for Tuesday? There will be policy meetings this week for the Fed on Wednesday, the European Central Bank on Thursday, and the Bank of Japan on Friday. I had to change that in my last video. I thought they were all happening on Wednesday. There are some very influential earnings reports that will be released this week, like Google, Microsoft, Meta, kind of big name companies. The technicals are positive, but I'm going back to just saying overbought. It's unsure if we're still working off this overbought condition or not. We're just kind of chopping around right now. We will get the FHFA Housing Price Index, as well as the S&P Case-Shiller Home Price Index and Consumer Confidence. Then we're keeping an eye on all the geopolitical events, but the market is still fixated on inflation and interest rates. We will be getting a lot of Fed speak on Wednesday, and the market's going to really react to that. Here's the updated economic calendar for the week, where we will have the FOMC announcement on Wednesday, followed by the press conference. Then we're going to get GDP on Thursday, and then we're going to get the PCE reports on Friday. So it's going to be pretty heavy as we go on. For the Stock Traders Almanac statistics, we are in the week after options expiration, and we're 50-50 that way. Looking at July 25th, we're positive for the Dow, neutral to positive for the S&P, as well as the NASDAQ. And we are on the 16th trading day of the month, where we do see a little bit of strength on this day. we might see a little bit of a bump up going into the FOMC announcement, and then historically anyway, we might see some more weakness going into the latter part of July. Also, more for the NASDAQ. We tend to see more weakness after we hit the middle part of July. So our scenarios, can't go with the down one right now. Our technicals are positive even though we're overbought. It's also really hard to go with the up one because we are overbought and there's a lot of looming things out there that could really have an impact on the market, especially in the short term. And we can't really go with the sideways trend right now because we are in a trending environment. So if anything, we would default to the positive. Our warning signs. Are we still seeing that convergence of these short-term bearish signals? In some instances, yeah, but they're kind of going away a little bit right now. The longer-term trend signals may be signaling that we're at a top. That's the longer-term weekly chart. We're still above those resistance levels for the S&P and the NASDAQ. The longer we can stay above that, the more positive it will be, but that could also change at any time. We're still coming into a seasonally and historically weak time of the month. The next few days are a little more positive, but then going into the latter part of July, it does turn historically weaker. The oscillators are looking better, but the one we're keeping an eye on is the NASDAQ 100, which is turning more negative. The VIX is still showing that there's not a lot of fear in the market. The cumulative new highs, new lows, that continues to be a drag on the internals for the NASDAQ. The 3-month yield is still above where we were at back in 2007. S&P 500 growth is weakening even though it's still in an uptrend. And then earnings season, which is going to play a pretty big factor later this week. The positive signs, we do have seasonality and setups that I went over in the weekly video. Those are still in the background. The special K daily chart is positive. The weekly chart could be turning a little bit more positive, but it's still negative. The longer-term equity put-call ratio remains positive. The S&P is still above that downtrend channel upper line. We're still far away from that. We're still in a risk-on posture, even though that took a bit of a hit on Monday. Lower price levels so far may provide support, but we haven't really tested those yet to see if they're going to hold. The S&P is outperforming utilities, even though it was down on Monday. The NASDAQ and NASDAQ 100, they're still above that breakout of overhead resistance. Can they stay above those levels? The NASDAQ turning negative with some of its momentum oscillators, that's something to be concerned about. The Staples to S&P 500 ratio is declining, and both the Russell and small cap indexes that we follow, as well as the mid caps, have generated recent golden crosses. Small and mid cap growth continues to be positive. And the Copic curve has generated a recent buy signal. So our conclusion, the S&P remains positive, but I've switched it back to more of just a traditional overbought condition. We don't really know if it's going to try to work this off or if we're going to see some real catalyst to move the market either higher or lower. We're positive but overbought in the short and intermediate term, and we're still positive in the long term as well. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.